Hi, everyone. This is Jason Bierach of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's master of the financial repression and finding out news about that. He's a former technology executive, senior management, and investment finance in international companies. Gordon T. Long, thank you for joining me again.
Jason, thanks for having me back. Always enjoy our discussions.
Now, Gordon, it seems to me a lot of people are calling this deflation, although, the people on Main Street, I don't think they're going to see a lot of beneficial deflation other than maybe cheap gasoline prices and maybe some cheaper asset prices coming up in the near future. I don't think they're going to see any real benefits of deflation, but it seems the credit cycle is tightening. Why do you think the credit cycle is tightening, and what problems do you think are going to end up being caused by the credit cycle tightening?
Yeah, Jason, you're right. We're in deflation, just as a separate point, and generally the public don't see it. And, here we had gas prices drop dramatically, and yet really it hasn't stimulated very much of any kind of growth in the U.S. or anywhere else, which is very, very telling, because it wasn't that many years ago. If you had, a 50-cent move in gasoline down, it had a dramatic impact to the economy. That says you have an economy, if you think of it as a bubble, that's just leaking and ripping and letting out air, something awful not to see an impact. But to directly answer your question, the credit cycle has returned down, has reversed. Credit cycles don't reverse very often. And when they do, it's a protracted period, because when they reverse, it ends up about clearing out debt, clearing out malinvestment, clearing out the level, deleveraging, if you would. In 2008, the credit cycle did not turn down. We had some minor initially deleveraging, as really it was just over margin kinds of situation. But this is clearly and without question a turn in the credit cycle. Now, why do I feel that, and what's different? I mean, there's evidence everywhere. If you start to look at high yield and the spreads, and we'll get into the yield curve. But basically, my experience, over the last 30 years, the credit cycle turns because cash flows in corporations, free cash flow, and EBITDA falls. Now, we've been watching the top line of most corporations. If you pay attention to the S&P, we've had no top line growth here for a couple of years. It's been negative. But slowly over the end of last year, Q3, we started seeing earnings themselves shrinking, or at least flat. Now, what's hidden the whole thing has been we've been reducing the denominator in earnings per share with buybacks. So it's kind of hidden the problem, but anybody that spent any time at it could see the magnitude of the problems and the push on margins, or the reductions in gross margins. But you can play a lot of financial engineering games to kind of buy time. But what you can't do, and it's why small businesses go broke even though they're making money on the surface, is cash flow. The cash flows in all of the corporations are now contracting. They're shrinking. Now, credit analysts, they look at it and they say, what's important? They go straight to the cash flow sheet and look at it and say, what's it look like? Then they go and they look at your debt. If your debt is shrinking, it's not really an issue so much, and so the credit cycle can drag on. If your cash flow is increasing and your debt's growing, but the ratio is still all right, it doesn't change the credit cycle. But what kills credit cycle is when the cash flows start falling and the debt is elevated or in fact growing, and that's exactly what we have. So it's just a game of arithmetic. So the credit analysts, they may not officially bring down the credit rating, but money starts to tighten immediately. They start looking for more collateral. Now, if you've got weakening commodity prices, weakening oil prices that are highly leveraged industry with tremendous capital expenditure that's all loan money with huge amount of debt, and it's levered, you've suddenly got a big problem when the cash flow goes. So then that starts the cascading, and then the spreads start to build. And that's what we're in. Now, what we have to really appreciate, too, is it takes a while for it to fully reverse. I mean, we have reversed, but to start seeing the impact, because it's slowly, well, maybe not even slowly, it starts to move through all of the various industries, the highly leveraged industries. And the focus right now has been, we've seen it in commodities and energy, but we're going to see it in more and more. And the spill out from this is significant, truly significant. Typically, credit cycles, we're talking 5-7 years kinds of cycles. So, because it takes that long to wash out the malinvestment. But it's as this builds up and gains momentum that you start to really have problems. And just to go on, if I could, on this, Jason, because you've got that happening at the same time. When you look at the United States, we have a flat yield curve. And matter of fact, I would argue that the yield curve is now inverting, because when I look at the 210, the 2-year subtract from the 10-year, we've had a triple bottom here over the last 2 years, 2.5 years. And in the last few weeks, we've busted through it. We've been holding the 118 pretty hard, and we busted through to 109. That's a signal to the banks. That's a signal to the credit analysts of the problems that are going to come with more or less cash flow. So it quickly reacts, and I think that's why you saw the banking stocks getting hit so hard. That's why you saw the sudden surge you're seeing in gold, because when we broke that 210, anybody who really understands credit and yield curve just said, push the panic button. And it doesn't mean it's going to go straight down, but you start to get big moves in it. Making sense to you?
Yeah, to add some examples to your points there's some larger oil and natural gas companies, an integrated one like ConocoPhillips, they were doing share buybacks and borrowing, billions of dollars to do the share buybacks. And now that their cash flow is down a lot, they're still stuck with the debt. So when they had a lot of cash flow, it made a lot of sense to do that. At least, a CFO crunching the numbers, you were a CFO in the past, it would make a lot of sense. But now they're stuck with the debt and they don't have the cash flow.
That's always the problem. And it's craziness. So they go out and they borrow. Now, there's reasons they want to borrow, Jason. It's actually smart for them to do that initially, because you can write off the debt, and especially when you can float junk bonds or bonds. They're actually high-grade bonds, believe it or not, at minimal amounts of money. And remember, Jason, when you're talking about these buybacks and borrowing money, they're not really going out and borrowing it in the public markets. Realistically, what they're doing, and I don't know if you're fully aware of this, let's pick on some of the bigger ones, Google, Amazon. They have Apple. They have $200 billion in offshore cash account. Offshore. All these major corporations, it's a fact. We all know the degree of the cash that they have out there. Now, if you're sitting there with that cash offshore, you don't want to bring it back and pay taxes on it. What are you going to do with it? You're going to stick it in the money market? If you're going to invest it, it's going to show up in your book. What are you going to do with it? Well, what you do is you put it into a SPE or an SPS, a special purpose entity, and that's an investment entity. You take that investment entity, what are you going to buy? You buy bonds. Well, whose bonds are you going to buy? You buy your own bond. But it's at arm's distance, so it's an SPE. So you're really taking that $200 billion and using it to buy the bonds. The bonds are then used to finance your stocks. At the end of the day, you get your money back from the bond, and you've got the stocks in your hand that have written down and drove your earnings per share up. Now now that your share price is higher, you take that and you do a debt for equity swap. In other words, you get on an airplane, you fly over to, Indonesia, who are getting crushed through the emerging markets, and you go in there and you buy an accretive company. You don't give them cash, you give them stock, and you print up another, 100 million shares, and you hand them the shares. This is ridiculous, but that's what happens when capitalism ends and financialization takes over. And that's basically what's going on here.
There are so many things, Gordon, that is ridiculous right now. Japan has negative rates. Is it crazy the yen is strengthening against the U.S. dollar when the Japanese central bank is trying so hard to devalue it?
It is actually logical, but you've got to understand where the hedge funds are. In fact, so initially it's kind of shocking, but quickly, it's my opinion, over a period of time, that the amount of money that's going to be fleeing Japan, that's going to be coming to the United States dollar, is going to create another overwhelming problem. I was talking to Graham Summers over at Phoenix Capital, and he's ballparking it somewhere around $9 trillion. I don't know, but it's going to be north of a few trillions of dollars. That's going to head to probably the U.S. dollar. A strengthening U.S. dollar is going to be a phenomenally difficult problem, and we're seeing it in the emerging markets who have borrowed in U.S. dollars. Their currencies are falling, their earnings are falling, and that's why Mike suggested earlier, you're going to see U.S. companies gobbling up some of these places at really attractive prices, I suspect. And by the way, it's not getting a lot of attention. Have you noticed the mergers and acquisitions in the last 18 months? They're dramatic, but they're not in the United States. They're offshore.
Yeah, there was a lot of LBOs of foreign companies starting about 5-6 years ago with strengthening currencies, and maybe now you're saying that's going to reverse. U.S. companies are going to reverse that and start buying foreign companies.
They're going to, because they're going to have to, Jason, because they have no growth. They absolutely have no growth. And I'm not saying that those companies have great growth potential, because they've got some real difficulties, but they're not as overvalued, because, you know, the rest of the world has been in a bear market for quite some time now, since at least May. And the stocks are down dramatically lower. Everybody in the United States is saying, oh, the market's selling out. There's nothing compared to the rest of the world. They're down 25, 28%, in many cases worse. This is a chance for probably something of the historic of debt for equity swaps for clever CEOs running major corporations. And as you know, I spent most of my career in corporations, and I can tell you they're not run by fools, and they have brilliant strategists who this is their job. This is their job to sort this kind of strategy out. They did not get into buying back the degrees of buybacks that we've seen for 2 years, which is just hundreds of billions of dollars, naively not knowing what the end game is. You just don't do that. Even if you're wrong on your end game, you better have an exit strategy. They have one. And I suspect they're in the process of full out, hidden, executing out that. That's my opinion. And especially with this amount of offshore cash. I mean, they're not sitting on that cash, not letting it leverage themselves up some way effectively. And I don't hear anybody talking about it. And which just shocks me. Which is, remember what strategy is, Jason. And I learned this when I first got into corporate life. Strategy is something that happens to you while you're looking the other way. And so when nobody's talking about it, nobody's looking at it, you know strategy's being executed.
Sounds like contrarian thinking there. That's outside the box. You're not doing what the herd is doing. You're trying to think like a good chess player, a couple moves in advance at least.
You can't run a major corporation if you're not that way. You won't survive. And it's as simple as Wayne Gretzky, right? They asked him why he was a great hockey player. He says, I go where the puck's going, not where it is. Sounds logical. It's a no-brainer. But that's what these corporations are gearing up to do. And it's because they have no choice, Jason. There is the global growth. You know, we accept growth, but it's not there. Global growth is shrinking. I would argue that real GDP globally has been shrinking for a couple of years. That has staggering impacts for many reasons, never mind cash flow.
Oh, yeah. It can't afford the debt then. If the cash flow isn't growing, then you can't afford to service the debt. So that's why they have these phony GDP numbers, especially when you add in a real inflation rate in so many different countries, which, you know, obviously governments have been working to hide the real inflation rate.
Precisely. Exactly right. The deflators that they use are absurd. So they you know, we do not have real GDP growth around the world. And another reason we don't have it is we haven't invested in the top line. Corporations have been using the money. We were just talking about buybacks. I saw 1,900 companies spent more money on buybacks and dividends than they actually earned, because the difference being they borrowed the money. So which says, okay, let's say that's logical. There was no top-line investment. If you're not putting money out for R&D, long-term investments, you're not going to see the growth. And when you see it in this magnitude, you predefine what's going to happen in 2 to 3 years. And this gig has been going on since 2010 at least. So it's going to show up, and we are. And the other reason is they don't want to take risk. Why risk going after an investment that you might have competition beat you might not have earnings power, regulatories may change, taxation may change. There's so many wild cards today. It says, no, it's easier to play another game on the bottom line, and it's immediacy, because capitalism now is not measured about what you can do 3 or 5 years out. It's what you're going to do this quarter. So you're going to play a short-term game, and that short-term game works for a period of time, and then you run out of runway. I would argue we've now ran out of runway.
I agree. It's way too myopic what's going on right now in society and from companies and stuff like that. And there's way too much rent-seeking behavior by governments and large corporations and special interest groups and Wall Street banks and things like that. But my next question for you,
Jason, can I interrupt you just a second? Sure. I just want, before we leave that subject, because it's absolutely critical. You know, we've had quantitative easing here since 2008, 2009, various forms. I understand. before we actually had QE1. But we've had cheap credit, and the whole idea was to bring demand forward. That was the idea. We kind of got ourselves out of the crisis on a short term of the first year and a half. And then we wanted, and Bernanke's argument says, okay, we're going to create the wealth effect. That wealth effect will create demand, and this is going to move the economy. Wealth effect, that was the top half of 1% or 1%. The middle class has been gutted. So we would argue, where's the demand? And by the way, if you bring it forward, that means there's a hole, a vortex right behind it somewhere. There's a big black hole. But forget the demand. The issue with quantitative easing is not demand, it's supply. Cheap money, and if you just travel around the world, it is blatantly obvious. Cheap money meant every little factory could ramp up, get into business, buy tools, and chase their market share. And if you add everybody's market share up, it's going to be thousands of percent. So we now have so much capacity out there around the world, specifically in the emerging markets that have been riding this, to the tune of about $7 trillion, of U.S. money that's been borrowed to support the build-out. Now what's happening is things are slowing. They're losing pricing power. They just don't have pricing power. And when you don't have pricing power, you've got enough to make at the end of the month in terms of payments, payroll, debt payments. What are you going to do, Jason? You're going to sell it. You're going to sell it whatever price you can get to keep you alive, right? Pricing power, that's what's hitting right now.
You don't have the savings, the surplus capital to make investments and grow your business. You can barely keep your head above water, service your debt, pay your bills, etc.
You got it. Sorry, I interrupted you, but you can see how from the credit cycle, the yield curve, the lack of the investment, that it's put us into this literally a spiral, a death spiral. So now, we get into what are the government going to do about it. Now we see this NERP and negative interest rate shocker out of Japan. So. Well, it wasn't the first one, right? We had it in Switzerland, we had it in Sweden, we had it in Denmark. EU did it 2 years ago, et cetera. And by the way, when the EU did it, you notice what happened with the U.S. dollar. It really started tightening because when the EU put in NERP. You look at the charts. That's why my argument earlier, you'll see Japan and the dollar strengthen, which is the worst thing in the world we can have right now is a strong dollar.
Now, Gordon, we've seen, I agree with you, a strong dollar is going to cause a lot of problems for many other countries who have borrowed too many U.S. dollars in debt. But do you think the Federal Reserve is also going to attempt negative interest rates soon? We've heard some Federal Reserve Board of Governor members, including Janet Yellen, talk about floating a trial balloon for it. Do you think they're going to actually try it?
I would have said a year ago, yes. Matter of fact, I've been saying this was in the cards and definitely going to happen. I think there's enough fear that's starting to set in of the unintended consequences that could come out of this, that they may really drag it out before they go. And that doesn't mean that when things get worse, in desperation, they won't try it here in the United States. But we may be the last one to do it. And some of the ramifications are people will immediately start taking their money out of the bank. That means you got issues with gold. So now you've got to really make sure that you've restricted cash, and this whole war on cash takes time to implement. Though it's like a freight train if you really study it, the amounts of things that are policies and regulations that are coming in to implement a cashless society, so they'd be ready for negative interest rates. But the banks are really warning them of what this means, so what's going to happen is the banks are still going to make their money on a negative interest rate, so they're going to end up pushing up fees, costs to the public, and so is that going to grow the economy? So
definitely not.
Exactly. So
it's going to transfer more assets, right, to the banking system and to the government.
Right. Well, that's the real driver behind this, Jason. Is it's about banks, and it's about if we go to let's start with a cashless society as a mechanism you absolutely have to have to implement negative interest rates. The reason people will give you you want a cashless society, all sorts of things, war on terror, laundering of money, black underground economy, lost tax money, you don't need it, it's more convenient, et cetera, et cetera. All sort of true. The real reason you want to do it is you want to lock the money in the banking system. And when the money's locked in the banking system, it can't get out, so therefore there are no bank runs. And then all money becomes base money immediately. And so you say, well, I'll be all right. My money's in the bank, and I can do with it. I can move it around. Well, then there'll be charges for moving it. There'll be charges of what you can keep it in. Never mind negative rates, which will then come in, which is one giant taxation. So, but it'll be sold. It will be policed or politicized in such a way that this is the right way to handle the problem. It's terrifying to me. It's really effectively surrendering our freedoms. And I think it's one of those policies that people around the world have got to stand up and say no, but I don't think they understand it and will be told well enough. They'll just say, oh yeah, I don't need cash. Does that make sense to you?
Yep. It makes sense to me, and you have a lot of people who don't like carrying cash at all because they have Apple Pay and they have Samsung Pay and they pay with a credit card and things like that. I mean, there is some convenience to it. You don't want to be carrying around too much cash in your wallet with the crime rates in some cities up. But, we've talked about...
Therefore, what you're going to do is go to cyber banking and you're going to get BitGold or Bitcoins, and you're going to use another version that'll keep your money outside of the banking system. They know that. But they're going to have to stop it, and I'm going to tell you that I think in 40 years, what I see with cyber banking and some of the underwritings that are going on right now for major, it's going to make BitGold and Bitcoin seem small with this whole blockchain. It's going to change banking, and that's what's a concern with the bank. They can see these policies are going to kill them, kill them in that. It'll allow new systems to come in place. People are not stupid. And then they're going to have to figure out how to stop it. And they haven't stopped BitGold or Bitcoin yet, have they?
Nope. And it sounds like a frustrating cat and mouse game for the people on Main Street, who are just trying to protect themselves from too much taxes and things like that. That, every time they think that they have themselves protected, the government just keeps on changing the rules.
And that is a given. No matter what. It's like everybody buying gold right now. I'm a big proponent of gold. But I can tell you, Jason, I honestly believe that even though we should on surface make a lot of money and it's inevitable, when that day comes, we're going to find ourselves being considered financial terrorists, and the taxation or the penalties or the transaction costs or whatever is going to say, there it goes, and the government takes it. And then by then they're going to, if we get it going towards a cashless society, they're going to have to prove where you had the assets. So if you're trading gold in a barter system, we're just tightening the screws, and that's why there's some of this is taking a little longer because they've got to tighten the regulatories to go with it. And don't think this is a conspiracy. This is a fact. This is what's going on. If you even study the minutes of some of the finance ministers when they're meeting. I just was in a discussion not that long ago. The finance ministers in Europe met in Berlin, and what was on the agenda? 4-hour discussion on a cashless society. And our Harvard professor here, what was his name? Anyway, he was there presenting why they need to do it or how they do it. It was closed door. What he was presenting, I'm just guessing, but that was the subject. So they're flat out on this because they're in a hurry. They know that the cracks in the dike are getting bigger and bigger, and they're running out of options.
Or even central banks now are looking into, digital currencies so they can track transactions and monitor supply if anyone's counterfeiting and things like that. So, they're trying to look to copy the blockchain technology so it benefits the government. But, all these things, they're all symptoms, I guess, of a totalitarian government. It's Orwellian, the stuff you just described, whether it's the cashless society or so many other things. Even to keep your own savings in a bank account, you're going to be charged, and government's just going to steal it slowly, whether it's through inflation or direct taxation.
You got it, exactly. We're moving from an era of Huxley to an era of Orwell. And that transition, and we're moving to, can you believe it, Jason? We're moving to more and more centralized planning and centralized control, almost in a totalitarian kind of approach. That is absolutely 180 degrees the way technology allows us to decentralize decision-making. 25 years ago, I was involved flat out in decentralizing decision-making and flattening corporations because it was the most effective and efficient way of running an organization. And here we got the governments centralizing power and control. It doesn't work. Yeah,
well, the people in power are blind ideologues. The guy Thomas Piketty wrote his book. He's a hardcore neo-Keynesian, and he was talking about how all the governments should unite for a global wealth tax to make sure that no rich person, 1%er or 1% of 1%er should be able to move their money from one country to another without paying taxes. So, I mean, it's all financial repression. It started off, I guess, financial repression was 1 degree, and then they just keep on adding, new layers of taxes, new layers of theft, new ways to screw the middle class and Main Street USA over. That's what it seems like to me.
Yeah, they have no choice. I mean, there's a lot of good people that are trying to do the right thing, but they're trapped with so many historically bad decisions, and then the only thing they can agree on is like bunch of men trying to design a horse, and they end up with a camel. Committees don't come out with good decisions, and trying to get consensus is a bear, especially when you've made a lot of bad decisions in the past. So the fallout is going to be bad. Now, this is in the short term. I would say in the next 4 to 6 years, it's going to be probably one of the worst times that we've experienced, and I mean that. I mean that actually positively, because it's part of a clearing of the decks, clearing of the system, bringing in new institutions. We're in a post-World War, or will be World War Bretton II kind of era, where we had to define the World Bank, had to define the IMF, the U.S. as a reserve currency. We're approaching, when this next crisis hits, and in that period of time, that kind of rebalancing and restructuring. That's the negative news. The good news is on the other side of this chasm. If you can keep your wealth, if you can preserve your assets, I think the world will experience one of the greatest growths we've ever had. The technology, Jason, that we have now. We have 8 billion people now that have fairly good educations, in many cases advanced education, that are willing, and we work harder today than any generation's ever worked around the world. And if we can harness that, and we have the tools like the internet to do that, can you imagine the kinds of advancements we can make for the betterment of mankind? And I believe in the human spirit naturally works that way, and naturally wants to prove and continue to grow. So I'll bet on mankind any time of the week. I won't bet on the government. They'll always be in the way. The government's always the problem. It's not the solution. And we'll go through some ugly spurts, because a lot of people believe the government's the solution. And then they'll find it's not. So we may have false starts in this period. But on the other side, it'll be a phenomenal era.
We have more people, who have studied science, technology, engineering, and math than in history right now. So there is a lot of high degrees there to implement technology and math and science. We're building rockets that can be reused. There may be space travel in a couple decades, at least like a little bit of space travel. So there is, and 3D printing. There's a lot of cool technologies out there that over the next couple decades are going to be pretty amazing, provided, I agree with you, government doesn't screw it up.
And they will. They will. That you can bet on. But you can also bet that after they've tried everything and it fails, eventually we'll come out another hole.
There was a Winston Churchill quote,
yep.
I think, about Americans,
exactly.
But I guess it applies.
Exactly correct. And he said, you can count on Americans to do the right thing. That is, after they've tried every other possibility.
Now, you've talked about the gold market and potential either windfall profits taxes or confiscation, but I don't think silver is in the same boat, because there are so many more thousands of industrial uses for silver. I think silver is a lot safer than gold in that aspect, although, if you're going to put a couple $1 million into silver, it's a lot tougher to move from one country to another. It's a lot tougher to store. But it looks like we finally have a rally going for gold and silver. Do you agree with that right now?
Yeah, I do. We broke here this week major overhead resistance. Now we'll go back, we'll fall back, and we'll test it as support, maybe even fall down a little further and bang around here. So, but don't ever underestimate the bullion cartel, and that's what we have, that have been manipulating physical gold and disconnecting it, rather the paper gold, from reality and the physical to do more damage. They're going to try, but they're running. The momentum has shifted, and it's going to be too expensive and too difficult to do, and there's not enough physical out there. So I believe we've broken out. I believe that it's not going to be a straight moonshot here. There's going to be some real ugly corrections in here. But I think we've now begun the trend out. And there's going to be more than one $100 day as we start to move out and move up with gold. But don't believe that you're ever going to get to keep what you think you're making. Silver, you correctly point out, I have a different view of. For all the negative reasons you just pointed with it, it's very, very difficult for governments to control silver the same way. So they'll go after the big guys with gold, but the little guys with silver will slip right in underneath it, in my opinion. So I think that things like silver may be your best shot. And $14, $15 an ounce right now. We had $54 an ounce. I mean, that's pretty good money before they start locking in any kind of taxation on it.
This is kind of similar to how the London gold pool ended then. How they've been fighting to knock down the price. Although, the London gold pool, the gold price was pegged at 35 and they sold lots of gold. They finally gave up defending that price because they were going to lose all their metal. Although they've been able to knock the paper price down, they've had to surrender an enormous amount of physical gold to China, to Russia, to India, to the Middle East in order to keep the prices down. But, there's not an unlimited amount of physical metal, especially when we see that on the supply side of gold, there's only 4 new gold mines coming on in the next 6 months. I mean, that's not a lot of production and reserves that are being replaced in the gold market.
Jason, just think what's going to happen when everybody decides that gold is starting to move, and they're not necessarily going to be smart people that are going to go out and buy physical, because the smarter educated people know that they want to be in the physical. They're going to say, I need to buy gold. What are they going to buy? They're going to buy GLD. So you're going to start to see a lot of money move into the ETF, the GLT, or the SPDR. Now, the problem with that is they've got to go out legally and buy gold. Can you imagine the gold squeeze that would be put on if just any sort of money starts moving into the GLD, ever mind those chasing the physical? The squeeze on this could be incredibly volatile, just dramatic. And it's shaping up like this, because when I see banks, and by the way, when we saw the negative, Japan make their move, when Kuroda came back from Davos, and at Davos he had no intentions, or at least was talking about NERP, and 6 days later, 5 days later, he does it. It says the fear of God was in him for some reason. Well, when he did that, you'll notice immediately the banks started taking, bank stocks were already under tremendous pressure, but all of a sudden you saw banks moving to gold. Not wholesale, some of them, isolated examples, but nevertheless, that was their reaction to saying, some of them to saying, I'm going to hold my money, I'll take it and put it in this. I'm going to start building a position. Can you imagine that just a few of them start to do that, what it would do to gold? Because it's such a small percentage, there's such a limited amount out there. It's really a nip standing in front of an elephant of money.
Yeah, and we know from the Shanghai Gold Exchange withdrawal data from 2015 that China bought more than 100% of annual global gold mining supply. So if that's just China importing that much physical gold, there's not as much physical gold for everyone else. So if there's new buyers in the market, it's going to have to, the only solution then between supply and demand, the price is going to have to go higher.
Yeah, and you can bet that China's got a big game. They've been buying aggressively for quite some time, and I believe their reserves are much bigger than they're reported. And so here you mentioned, I think earlier, about China and the weakening of the yuan, and they've been busy trying to shore it up continuously. 60 billion here. It seems like every second or third week I see it. You're seeing the reserves falling fairly dramatically, which means there's pressures on U.S. Treasuries as they're offloading some of this just to shore up their currency. Well, at some point, I think they want the currency to go down, but on the other hand, they need the capital infusion to reverse the capital flight that's going out, because you need to appreciate that 42, or at least used to be 42% of the GDP of China is capital formation. It has great imports, or great exports rather, but it has great imports. They net out. They're huge, but they net out. It's really the GDP is capital, and when it's going out, that's what really impacts their GDP and everything else. So they've got to reverse it. So there's some issues. But at some point, that currency is going to come down. The yuan is going to come down. Now, there's some ways around it. And one of the ways that they have is they could simply say, look, we're going to partially gold back the yuan, 10%, 15%. That changes the whole parameter of a reserve currency around the world.
That'll blow up some hedge funds too if they do that who are short.
It will actually blow up some countries. So they don't want to do it, but if their push comes to shove, and they're getting some serious situations, they're capable of doing that, to play that card. And you can imagine what that would do to gold prices. So I other than the tax, I don't see confiscation, but other than the tax grab from the government, I see limited downside. I see it as all upside. It's certainly the cheapest insurance I can see out there, especially when you look at the carrying cost of gold versus the carrying cost of a bank account with negative interest rates.
Yeah, I see all the major economies in the world, and now China including, trying to manipulate interest rates however they want. So, all the major economies, the developed world and China, are all trying to manipulate interest rates. The developing world doesn't have as much ability to manipulate their interest rates as much because, they're more beholden to the larger economies. But what we've seen, Gordon, is a lot of these sovereign wealth funds, you mentioned a little bit of this earlier, having to sell their treasury bonds, but they've also, the sovereign wealth funds have had to sell their equities. So that's going to crash the stock markets too. They need that cash to protect their own economies from social unrest, especially if they're like Saudi Arabia or an OPEC country. And, they need to dump those treasuries for cash, and they need to sell their equities for cash and bring that home. So we're in a situation now, I think, and this is the way I see it from the Wall Street money managers. A lot of these guys who are Keynesians or more mainstream, they hate gold, but they see that the stock market is going down. There's going to be a lot more, maybe even the stock market's going to have a big crash in the near future. And they see that this increasing volatility, it's going to benefit gold. So they're starting to build up positions again in gold, silver, and gold and silver miners again.
Yep, precisely right. I don't know if we're going to see a crash. I think we're going to have the fear of one. But don't ever underestimate central bankers and government and what they'll do. And we're still early in the kinds of things that they will try. I can see, as the market's coming down, them stepping in and guaranteeing collateral values and guaranteeing, Japan, they've been buying the Nikkei. So you could see the central banks across the board, if they're not already, buying stocks to keep markets up.
Yeah, and that's frustrating for people who want, honest, transparent markets, free markets, where they can make sound investments or smart trades, long or short, because, the government's going to, like we talked about earlier, the governments are just to benefit them. You don't know. Wall Street may have inside information on this. They're just going to change the rules.
Well, if you want,
so you don't.
I was going to say, if you want clear and transparent markets, then remove yourself from the publicly traded exchanges.
Yep, exactly.
Those days are gone.
Yeah, just take cash and take metal and get out of the system then if you only want transparent markets. I mean, there's still some small companies on exchanges that, they are growing their revenues. You can tell free cash flow and things like that, but most of the larger companies are not doing that anymore. They're playing financial engineering games.
Precisely. The biggest concern, and the thing that I think should worry our listeners right now is more basic. I believe the tax grab that's coming from the governments in 2016 and 2017 is going to be horrendous. And by the tax grab, I mean, because you can see all the pressures of revenue that they're going to have needing money and budgets with the size of the debt, even with reduced interest rates. So right now I can see at all states, all levels of the government, federal, state, and in the United States at the local level, and I'm seeing already at the local level. The federal government prints money and hides it. The states that we're seeing at the state level, all sorts of various games being played there. I see Illinois increasing its sales tax up north of 9%. But right now, there is a huge wealth increase that's happened, the wealth effect for a lot of wealthy people. But in housing prices are elevated. I'm not saying we're in a bubble right now, but they're elevated compared to what they were a few years ago. And all of these local towns and municipalities and cities, that's their only way. They're going to tax housing. And so we're seeing the tax on property now starting to really shoot up. And it's getting to be, in many cases, the size of your Social Security check. So you got 75 million baby boomers retiring, and suddenly their taxes on their house that they thought are going up and just consuming it. And by the way, Jason, if you look at Social Security with these 75 million baby boomers retired, they don't really understand how the tax game works on your Social Security. You get a check from the government for your Social Security, but if you make over $35,000, 50% of your Social Security check is taxable. They take back 50% of it, of the amount over $34,000. Over $44,000, they take back 85%. 85% of your Social Security is taken back of the money over that $44,000. And how brutal this is. To live today, you can't live on $30,000 or $40,000. So it's forcing people. That's why a lot of the older people are working. They're not making any money on their investments, zero. They're consuming it. They're scared. They're going out and work. So now they got a job. They're packing bags over at the local grocery store. They've pushed your earnings up to 55 or 57, so they're not eating dog food. And the government's turning around and cutting their Social Security check because of the tax on it over 44. They're just going, oh my goodness, I didn't know that. And
even worse than that, Gordon, a lot of their stockbrokers have put them in junk bond funds for income, so they're going to get slaughtered there too.
Exactly. And then, so we've got property tax, we've got civil forfeitures, which is just measured in the billions going on now. There's means testing coming, licensing fees, usage tolls, inspection fees, processing fines, ticketing. Police now are being incented for ticketing levels because they're using that to offset or to handle the budgets. Inheritance tax. I can go on. I actually wrote an article and I laid it out, and I just ran out of different areas. I had to shorten it up, and every one I had examples of aggressive natures of taxation that's coming. It's only beginning. That's the fear I have.
You're not even talking about the online national sales tax or VAT tax that may come. I think Ted Cruz, it's in part of his tax plan. And if the Democrats win both houses of Congress, they'll pass carbon cap and trade. So you're looking, and you made a great point about this, and I've researched this too. I've sat in lectures at conferences here in D.C. from the American Tax Foundation, which is an independent tax lobbying firm. They're not on either side of the political aisle. They just care about the American taxpayer not getting screwed. We're going to see dozens and dozens of taxes layered on. And a lot of people, if their income's rising, if they're doing well financially, they're not going to notice quite as much. A lot of these Wall Street guys, they're not noticing their tax bills going up or their grocery bills going up because, they're making all this money on hedge funds and things like that. Or their butler buys them groceries, or their wife goes and buys it, and they just write the check and they don't care because they're making so much money. But the average guy on Main Street, who's barely getting by, people who are working 2 or 3 part-time jobs, or, families barely struggling with very little savings, living almost paycheck to paycheck, they're going to notice when all these new taxes are layered on. They're just not going to have discretionary income going forward.
And that's already happening. The discretionary income's not there. That's why we don't have demand, and that's why they're slowing. But my advice to our listeners is really get serious about all these line items because they're going to add up. And if you're getting close to retirement or you think you're going to be retiring, you really need a spreadsheet to start looking at these things. They are significant, but they're just nobody pays any attention to them. But the government, but the bureaucrats do, and it's not in a coordinated fashion. All of them need money, and this is the way they can get it.
You nailed it, Gordon. I mean, when tax revenues drop in a government like Canada, which has resource prices declining, they're looking for companies that are still profitable to go after to change the tax rules on to say, hey, you're the only profitable resource company. We're short X amount of money on dollars because taxes have fallen. We need to go after you now. So they just view people or companies as milk cows that they can keep on milking more and more when there's budget shortfalls. There's also inefficiencies if you know more about how governments work, and I live right outside of D.C. Governments are not efficient with their spending. They don't keep a budget. So they don't keep extra money surplus. The way government spending works is they're given a certain amount of money a budget, and if they don't spend all the money, they're in trouble. And then they're supposed to spend all the money that they're given in their budget and then ask for even more money next year or the year after. Or the person in charge of the budget in that government agency gets in trouble. Yeah,
whatever happened to zero-based budgeting? I guess I'm dating myself. That was the model 25 years ago. I guess it just went by the way. But these are the. I remember I said strategy, something that happens to you while you're looking the other way. Well, that's what's going on here. And is all of these fees, means testing, et cetera, they just keep slipping in every month, at all levels. And I need to stress that, all levels, federal, state, and local. And it's the state and local that have the biggest problem right now.
Yeah, I mean, Benjamin Franklin, I think, said the only two things in life guaranteed are death and taxes. I would add inflation in there as long as there's a functioning government. Hello?
No, I'm here. I didn't want to interrupt you.
Okay.
Making sure. They need to bounce around all these various subjects, but they do integrate, right, Jason? They all tie together, and it's a spiral that we're in. And, a comment I'd make, too, the big focus has been on China and energy and commodities and the problems there, and that's a whole show in itself. But right now, I'm seeing an EU banking crisis again that's looming without question. You see the damage at Deutsche Bank. I think I smell a major derivatives crisis that's going on behind the scenes, and I think it's probably in the swaps marketplace right now. And so you've got a lot of issues with these highly leveraged European banks. Average European bank officially is 26, 25 to 27 to 1. I mean, Lehman Brothers collapsed at 32 to 1. So 4% drop and you're gone. And people like Reggie Middleton says, no, that's bogus. It's closer to 55 or 60% or higher. So they never fixed the problem at all in Europe. So this EU banking issue could quickly get out of control. And everybody's talking about a strong U.S. economy. Now we're starting to talk about weakness more in the common press. I happen to believe we're in a recession already, and time will tell that. If you look at train traffic, rail traffic, shipping, there's almost no container ships at sea right now. Do you realize that? When you look at the tracking on it, we got the Baltic rate at a rate we've never seen this low. It's more effective. It's more cost effective for a shipping owner to leave the ship in dock than send it out to sea because of the fuel costs, even with cheap fuel, and for what they're getting on their cargo. They're not even sending them up. They're not even taking the deals, and there's no volumes there. And I'm not exaggerating, but let's just say I am. It says that no matter what, we have a slowdown that's going to wash ashore here in the United States of a significant magnitude, and we're not ready for it. We're still in la la land here.
Well, they're trying to sell people that the economy is still doing well. They're trying to do this Keynesian animal spirits bullshit that as long as we keep people optimistic and hoping that the economy and telling them the economy is good, they're going to go out and spend money that they don't have. But that's not reality. I would go further.
Well, did you hear what Trump said the other night? I'm not a big Donald Trump supporter, but I thought he said it quite well. He says, if you really believe we have 5% unemployment, do you think this gymnasium would be filled to the brim? He says it gets filled to the brim if you have 40% unemployment, or you can't get a job, or your job doesn't make enough money. That's when people come out. So when you look at the two candidates that are leading on both sides, but between Bernie Sanders and Donald Trump, is because they're anti-Washington, they're anti-establishment. They can't be any stronger in saying the biggest problem is Washington, which tells you the anger and the building resentment and that we have across America. What we have, Jason, is a crisis of trust right now. We have lost trust in the system, especially the youth right now. And when you have a lack of crisis of trust, because it's really a failure of leadership, you get stagnation. You stop investing. You stop taking risk. You start going to a protective strategy. That's why small businesses are doing it. That's why corporations are doing it. So you've got to have confidence in the system. And if you look at any of the from Gallup polls, any of the surveys that have been put out, it's growing at a phenomenal rate. This absolute lack of trust. People generally in most of these surveys say they believe the U.S. government is corrupt. And that's a hard thing as an American citizen for me to say. But that's what it's saying. So that says the seriousness of this issue. And then if you take all these problems we've been kind of dwelling on here, overlay them, this is not a pretty picture. But it says it's change trying to happen. Things are wrong. And so it's going to force it to a boil. It's going to force a crisis. And then we can really get on with the show instead of living in this false world. And that's what this is.
Yeah, I'm tired of the status quo. It's clearly not working. They could have solved this by allowing a recession. After the technology bubble, they could have let things start to clear, markets clear in 2008. They didn't let any of these things happen, and instead they just tried to either create new bubbles or reflate the old ones. You said there's a recession. Now, I would go further. I would say there was no real recovery after 2008, that it was a zombie recovery. The only boom or bubbles there was the shale oil boom, which was on, cheap credit, and a lot of the shale companies didn't even make any money, and then China's stimulus plan. Those were the two things that drove after 2008, really, besides central bank, propping up asset prices. So the real economy didn't see a lot of growth, a lot of real economic growth after 2008. So I think there was no real recovery, and there's just been a lot of papering over, especially asset price inflation, and, that wasn't going to go on for forever either.
Yeah, the government's practicing an investment policy of prayer. They're just praying that some miracle will happen and it'll take off if they just kick the can down the road and buy more time. Sometimes it works.
That's Keynesian economics. It's all false. It's all based on false assumptions and bad science, and it pretends it's a science now with the neo-Keynesians and all their equations. So it's hopium.
So you can't run a country. It's like a caterpillar. It's got all these little handles to turn and steer a caterpillar. If you only have one lever, the caterpillar will probably go around in a big circle and go nowhere, right? You need multiple gears. Well, it's the same way with running governments and sovereign nations. You can't run it with just monetary policy. That's only one lever. And we've far extended what it's even capable of doing. Monetary policy is about solving a liquidity problems. We have solvency problems. That's a whole different problem. And they may be able to lower interest rates and buy a little more time on the solvency. But you need fiscal policy. You need public policy. And public policy, I'm talking about taxation, incentives, structural directions, structural changes. And in fiscal policy, of how the money's spent, how it's raised, and how it's distributed, or maybe another way of saying it, the size of the size of the government in relative to the size of the GDP. So right now, those two have completely abdicated their responsibility, and I would blame that and put it at the foot of the politicians, the Congress. And have simply handed it to the central bankers. So as hard as I get on the central bankers for the monetary malpractice, they put in an impossible situation. And so they're pulling rabbits out of a hat buying time. But I don't believe for a moment that any of them really want to do this. They just feel they have no choice.
In wrapping things up here, Gordon, I think we're starting to see a lot of the mainstream people who would not have bought gold in the past, people like Mark Cuban. He just admitted today he's been buying lots of GLD call options. Stanley Druckenmiller, a former money manager for a billionaire money manager for George Soros, admitted he bought a lot of physical gold. So we're starting to see people who normally in the past, they would have put money to work in small business or other investments, and they're moving their money out and putting in gold. So I think they're starting to realize there's problems with the system. But please tell our listeners where they can find your work and about your YouTube channel.
Yeah, thank you very much, Jason. Enjoyed the discussion. Lots of different subjects there. We have a couple of YouTube channels, but Financial Repression Authority and macro analytics, and my site, Gordon T. Long. We have a special site we brought up now called the Financial Repression Authority, which simply focuses on some of these subject areas. And we have another site called Triggers.ca, which is really a trading platform for swing traders and position traders. We try and eat our own cooking.
Yeah, I don't like hypocrites either, but I just want to thank you again for your time, Gordon. I enjoyed the discussion, and let's do it again soon.
Talk to you later. Have a good weekend. Bye-bye.